Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CINTAS CORP quarterly report. CINTAS Corporation offers a diverse range of businesses and services, including uniform rental and service facility services, first aid and safety services, fire protection products and services, restroom cleaning services, and supplies sales of uniforms distribution network, and local delivery, routes local representatives for small to large corporations. These services cater to both small businesses and major corporations, providing a comprehensive solution for their uniform and facility needs. The stability of CINTAS Corp. (CTAS) stock price over the past year can be attributed to several factors. On one hand, the company has consistently reported strong financial results, exceeding earnings estimates and raising guidance for both revenues and earnings per share. This positive news was further supported by shareholder returns, including increased dividends and significant share repurchases. However, this bullish sentiment was likely offset by mixed analyst ratings and price target adjustments. While some analysts maintained buy or moderate buy ratings, others expressed caution with hold or varying price targets. Additionally, insider selling of over 5,000 shares in July 2025 may have contributed to a minor negative signal. Ultimately, the combination of positive operational strength and mixed analyst sentiment likely led to the observed period of limited stock price fluctuation, resulting in no significant changes in CINTAS Corp's stock price over the past year. The primary drivers of revenue growth or decline in a company can be attributed to several key factors. In the uniform rental and facility services segment, revenue growth is driven by an increase in new business sold by sales representatives, penetration of additional products and services into existing customers, price increases, and strong customer retention. Similarly, in the first aid and safety services segment, revenue growth is fueled by increases in new business sold by sales representatives, penetration of additional products and services into existing customers, and price increases. Strong customer retention also plays a significant role in this segment's revenue growth. In addition to these factors, other revenue streams, including those from acquisitions, contribute to the overall revenue growth rate. The positive impact from acquisitions is estimated to be 0.8%, highlighting the importance of strategic business combinations in driving revenue expansion. Net income and profit margins experience growth between 2024 and 2025. The company's net income saw a significant increase of $39.1 million, representing an 8.7% growth. This upward trend is mirrored in the operating income margin and net income margin, which also experienced slight increases during this period. The improvement in profit margins can be inferred from the rise in net income. The reasons behind this change are multifaceted. While unfavorable changes in working capital led to a decrease in net cash provided by operating activities, the increase in net income partially offset these negative effects. Additionally, a reduction in share buyback activity and an increase in dividends paid also contributed to the shift in financial performance. The company's financial performance indicates a consistent generation of positive operating cash flow. The data from the past 2 years shows that net cash provided by operating activities has been steadily high, with $414,481 in 2025 and $460,357 in 2024. This trend suggests that the company is efficiently managing its operations to produce significant cash inflows, which is a positive indicator of its financial health. The company's financial situation regarding debt and interest expenses has undergone some changes. Notably, the net interest expense decreased from $24.4 million to $22 million, indicating a reduction in costs. However, total debt due after 1 year increased by $758,000, suggesting an overall increase in debt levels. Long-term debt also saw an increase of $934, and interest rate lock agreements rose by $3,510. These changes indicate that while the company has managed to reduce its net interest expenses, it has simultaneously accumulated more debt. The company's financial performance reveals a mixed picture. On one hand, the uniform rental and facility services segment stood out with impressive growth rates, including an 8.1% revenue increase and 7.3% organic revenue growth. This segment also boasted a high gross margin of 49.7%. However, other segments or regions did not fare as well, with costs increasing as a percentage of revenue, implying underperformance in these areas. Management is optimistic about the company's financial prospects, citing sufficient cash flows to meet liquidity needs for at least the next 12 months. While acquisitions, stock buybacks, and dividend payments are considered strategic objectives, they will be contingent upon the economic outlook and available liquidity. This suggests a cautious, yet forward-thinking approach to managing the company's finances. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $157.8 million in 2025 and $138.2 million in 2024. Additionally, the company has been actively buying back shares, with a total repurchase of common stock amounting to $1 billion from July 26, 2022, through September 2025. That concludes the financial summary for CINTAS CORP. Feel free to comment below, and I will be happy to answer them when possible.